The Rebel Capitalist Show. Even if you are a long-term investor, I think there's an edge if you understand options.
What I want to talk about is two circumstances. Number one is that how do you repair a gold mining position that you have that is now losing money? So some people may have really loved the gold trade and got in 6 months ago and now find themselves in a situation where they're down on their existing gold mining position. How do you repair it? And then the second thing I want to cover is if we are in fact at one of these turns, how do I put on an asymmetric trade to leverage the upside while not exposing myself to that same leverage downside risk? Right. And so I want to show some really exciting strategies.
I want to be clear, these are things that you've done in your own portfolio lately, Patrick?
In fact, the two trades that I'm literally going to show are live trades that I have on with my real money that I actually screenshotted from just an hour ago. Okay, cool. So we're talking about literally trades that we put on. And I want to talk about this opportunity and how to put this on. I want to share with you a trade that has gone terribly wrong for me and how I fixed it. All right. And so what I want to talk about is back in the summer, back in July 2021, just a few months ago, I was bullish gold miners. And so I was focusing particularly on Wheaton Precious Metals. I really love the company. I thought it was a great opportunity. And so I went and purchased $90,000 or 2,000 shares of Wheaton Precious Metals at $44.82. And so just to kind of show where it was on the chart back in July, it was trading right around this level. I looked at it as a Fibonacci retracement. I thought it was actually breaking out of a wedging formation, and I thought it was going to bullishly start to advance.
So you bought it right there where it gapped down?
No, literally that last green candle.
Oh, right.
So that little red line, which is aligned with the green arrow, it's about $44.82 on this chart where I bought it. So I didn't buy it at the bottom. I bought it as it was turning back up. Now, I was early. Now it followed through for a few days, but here we are, and at the end of September, when I was having lunch with Ronnie Stofferly out in Vienna, the Wheaton Precious Metals was trading at $37 a share. Now, I was down $7.82 per share, or roughly $15,000 on this position. More importantly, Wheaton Precious Metals from its late August high in just 1 month dropped 20% in 30 days, just went straight down day after day. It was like you might as well grab a bucket and puke, right? Like it was like, it's not a great feeling seeing a stock that you're bullish and holding go through this type of a decline. Yeah. But at the time, I looked at it and said, it's approaching a major support line. It's 52-week low. Its low of the year lied down around $35 a share. And here we were
going back to March of 2021.
Exactly, right. That entire blue zone down there. Right. That was the lowest Wheaton Precious traded in the 2021 year. And I'm thinking, it's got to at least bounce off of this level. Maybe I forget about a new uptrend or anything like that. I just think that this was a tactical place. Now, the most common strategy is to dollar cost average. Well, if I bought some at 45 and now it's down at 37, I think it's a bottom, then I'm going to buy the shares, bring my average cost base down to half of the amount because I doubled my position. And I can now repair my position through a traditional dollar cost averaging, right? And that's something I'm sure you and many of your listeners would commonly consider doing. Now, I did something very similar to it synthetically, and I want to go through the thought exercise of what I did and how I repaired this position. And so what I did was, the first thing I did, so just note, what was the lowest it traded? It traded at $35, right? even though the stock's trading at 37 at this moment. The lowest it traded was 35. And so what I did was I sold $35 strike put options for $1 income out to November. And I basically collected $1 income. I said, if there was a price level that I'm going to dollar cost average at, it's going to be at the $35 mark. If they're going to force me to buy the shares and I'm going to dollar cost average my 2,000 share position, I'm going to do it at $35 exactly. And for this, I'm going to earn $1 income. So I snagged over $2,000 income in selling that put option, obligating me to buy an additional 2,000 shares of Wheaton Precious Metals at $35.
Right.
Now, what I did secondly then was I used the proceeds and some of my extra cash to buy 20 $37 strike call options, which were trading at $1.95. Now, so let's talk about what a call option does. It's the right to buy the underlying security at $37. And for that, I'm paying $1.95 a share, or I paid $3,900 to buy these call options. This has secured me a guaranteed purchase price of $37 a share down there. So I have said either I'm going to get stuck owning it down at 35, or I've guaranteed myself $37, no worse than $37 entry. And net, it cost me under $2,000 net because I only made 2,000 income and paid 3,900. So what ended up happening in the last 2 weeks is Wheaton Precious Metals came off that $37 low and now has snapped back to $41. Right. So my original purchase was up at near $45. Today it's at $41.33 at the time we're recording. So I want to show you what now my position looks like. At one point, those 2,000 shares of Wheaton Precious Metals was down $15,000. But I bought those November $37 calls and sold those $35 strike puts as my repair strategy. And today, once just that we had this little snapback rally to $41, I find myself now actually at break even on my Wheaton Precious position. I'm up basically $7,000 on my options, that I'm down $7,000 on the stock, and I've already reached my point of break even. Now I'm already, once I take profits on these options, I now am back to making money on Wheaton Precious. So I went through this devastating market drop. I repaired it along the previous low. And here I am just after a 4-day little snapback rally, I'm already in a position to make money on the upside of Wheaton Precious.
Yeah, that makes a lot of sense.
Right. And so now this is just one way of repairing it. There's a second way of repairing the option strategy through the application of a debit spread and through using a covered call approach to repairing a trade. And it's one of the ones that I'm excited to share with you and your listeners. It's one of the many ways to fix positions. Now, in this particular case, am focused with you on gold and gold miners, but these option strategies can be used to repair almost any stock position that has a liquid options chain on it. So the next thing I wanted to touch on, though, is how I was leveraging the upside on some of these gold miners with a brand new position on Equinox Gold. And this is a live position I have in my portfolio. And I want to talk about how I made it asymmetric in my favor. And so in this situation, I wanted to talk about Equinox Gold. EQX, both trades on both the Canadian and American exchanges. And I was bullish after seeing a technical basing formation after that big sell-off. And I was looking at how can I create an asymmetric trade where I'm getting about $50,000 of upside potential on Equinox, but at the same time managing my downside risk. And so I created a really neat option combination in my portfolio, and I want to share it with you and and the listeners. And so this was where I took the trade. Equinox Gold was trading around $7.20 a share after spending the entire summer basing. Many of the gold miners were making lower lows, but Equinox was establishing a base. And even though it was selling off for over a year, we saw a lot of the technical things that I look for on a stock that is bottoming and basing and creating a tradable bottom that is worth speculating on. And there's no guarantee any one trade will work, but there are unique periods where you want to make sure you have skin in the game and put that on. So now I want you to really remember that $7.20 level, because it's important to put as a reference point for our next slide.
Okay.
What I chose to do with Equinox is do a put call combination. Now, typically when you do an equal amount of puts and calls, short puts and long calls, it's a risk reversal long equity position. What I chose to do is ratio it slightly in the money. And therefore, what you can observe is I own twice as many call options as I have short puts. I have 60 call options on the upside. So that gives me the right to buy 6,000 shares of Equinox Gold at $7.50, which is a $45,000 position in Equinox, which is roughly what I wanted exposure to the upside on the stock.
Okay.
Now, I only sold 30 put options on Equinox at 7.5, which is an obligation to, if it's assigned to me, to buy 3,000 shares of Equinox at 7.5, or only $22,000 of stock. Now, because Equinox at the time was 30 cents in the money, which is that, remember, it was set $7.20. I have agreed to have someone be willing to sell it to me at 7.5. In other words, I am agreeing to buy it 30 cents higher. More importantly, my upside on Equinox doesn't kick in till it's north of $7.50. So I have put my kind of pivot on Equinox 30 cents higher than where the stock was trading at 7.5. In doing so, I was able to buy those call options at 35 cents a share and sell the puts for 70 cents a share because they were in the money. I was able to literally do this trade at a zero cost. In other words, I paid $2,000 for the calls, but yet earned $2,000 income for the puts.
You're right.
So literally at this moment, it is a zero cost options trade that needed $10,000 margin to carry. Okay. So think about this. I'm only allocating $10,000 of margin on the side, and I have bought a position that is giving me $45,000 upside of potential equity upside on Equinox, and only undertaking an obligation on 3,000 shares. So what we've created is a scenario where our pivot is the $7.50 strike, which is just about 30 cents higher than where the stock is trading. So what I want to do is go through a scenario to explain what I've created. So remember, if we just bought call options, we would create the convexity of that blue curve, which is the stock is trading at the orange line delta, a 45-degree angle of, if it goes up $1, I make $1. If it goes down $1, I lose $1, right? Like that's your relationship of the stock. The blue is the convexity that comes in the optionality of you having a call option. Rather than having that convexity and pay for it, what I created was a trade that looks like this, which is I have all of the downside risk of owning 3,000 shares of Equinox at $7.50. So dollar for dollar, I have taken all equity risk on the downside of owning Equinox at $7.50. But if I'm right, I'm making the upside potential of Equinox on 6,000 shares.
Right.
And therefore, I've leveraged my gains on the upside. And remember, this option strategy cost me 0 to open. And so, what I'm going to demonstrate this in the simulator, but I want to show you where the position is trading right now. So Equinox at the time right now as we're trading or speaking is trading at $7.83 a share. So it's now actually moved in my favor. And I find myself in a situation where I'm already up close to $3,000 on this position and continue to have the further upside of this.